Hello, welcome to another session of financial accounting where I'll be talking about the assignment that was given to you on cash flow analysis. Chemalite Inc. B is what is the name of the case study that was given to you, and I have received your answers while I feel that there can be a lot of improvement in your understanding. So I thought that I should be sharing this video with you. Well, let us just look at the case. The case speaks about Mr. Alexander, who is facing a bit of a challenging time to present his case in front of the shareholders, and then we just will look across this 11 points that was given to us. He says that you have got this wholesalers. The first point says that the wholesalers actually are taking more time to pay back the money, and then you find that the stock, because the collections come in late, the stocks also need to be increased, and that is what has been told in the third point, where the average material of the inventory would be $75,450. Well, the important point which we can see here is the fourth, fifth, and the sixth one, where they say that the facility of the production is being increased, and that is the proposal where the total cost of the facility would come out to 8,50,000, of which 2,50,000 corresponds to the land. And the other point which we find here in the fifth point says that you can pay this money 50% right away, and the rest of the 50% can be paid later on. And here we also see that the total, while he is improving the facility, he also sells away a part of the machinery. So the part of the machinery is being sold for 2,15,500, and a new machinery is being bought. So we will have to factor in all these things to find out whether Alexander can actually make a good presentation for the shareholders, and can actually satisfy them with the questions that they will be asking. So it was asked that prepare a cash flow statement using the indirect method. The second one was using the direct method, and the third one is that what do you understand by the analysis, and what do you recommend to Alexander. So these are the four questions of which we will be solving. The first one, the third one, and the fourth one. We will not be doing the cash flow analysis as per the direct method. We will only limit ourselves to the indirect method. So I have put up this in a Excel sheet, and let's see how it works. So whenever we are talking about cash flow as per the indirect method, we are going as per Ind AS 7, where the Ind AS 7 gives you a very clear-cut guidelines on how you are going to work on the interest, and how are you going to treat the financing expenses. That is, interest is part of the financing expenses. While most of you people have actually shown it as operating expenses, where I'm not very clear where you got this point from, but operating expenses, interest is not treated as an operating expense unless it is a financial organization or a financing organization. While I see that Alexander is into manufacturing, so interest expense won't be treated as operating expenses. It should be treated only as financing expenses. Please refer to Ind AS 7, the link of which is being sent to you along with this document. Now let us see this fourth, fifth, and the sixth point which I told you earlier. So it says that the fourth point says that the land, the facility is being acquired for 8,50,000, of which the land works out to 2,50,000. Let me start with the working first, and later on I'll talk to you about the indirect method. So here the land, he says that the land is being acquired for 2,50,000. As you very well know that the land is an asset, and the assets have a debit balance to start with. You will have to start with the opening balance on the debit side, and whenever you are acquiring the asset, it goes on to the debit side, and whenever it is being sold, it is to be taken on the credit side. This is a very basic structure of accounting. So here he says that the asset is being acquired for 2,50,000. That is, the land is being acquired for 2,50,000, of which 50% is paid away right away in cash. That is 1,25,000 is paid in the form of cash, and the rest of the amount is not paid right now, which will be paid later on. So I consider this as notes payable, which is found in the balance sheet. This is seen in the balance sheet that is provided to us in the problem. So you find that notes payable, which is 4,25,000, I consider that 1,25,000 is part of the notes payable, which is a balancing figure. of the total opening balance, which was 0, you find that the land is 2,50,000. So when you balance it, you find that you have paid a cash of 1,25,000, and 1,25,000 is a balancing figure which gets into the notes payable. Let us look at the next point, which says that machinery is, out of this 8,50,000, 2,50,000 goes for land, so rest of it goes into the machinery. Let us prepare the machinery account. Before we get into the machinery account, let us also look at the provision for depreciation. The reason why we are looking at provision for depreciation is we find that in the case of balance sheet, you find that the long-term assets are given over here. What's the long-term assets? The plant property equipment is 2,12,500. So of this we will just work out how it goes on. Now why did I take this provision for depreciation? When I look at the balance sheet, I find that the accumulated depreciation account is shown separately, hence I open the provision for depreciation account. These are the balances. The opening balance of the depreciation is 10,625 and the closing balance is 56,000. Let's see how it appears here. So the provision for depreciation, as I said, that the opening balance is 10,625. We take it on the credit side. Provision for depreciation is a liability. Liabilities will always have a credit balance. So start with the credit side, 10,625, and the closing balance, which is already given in the balance sheet, that I am picking up and taking up here, 56,000. That is taken here. Now let us look at what is the depreciation for the year. Go to the P&L account. What is the depreciation for the current year? Now let us look at the depreciation for the current year. It says that it is 61,625. 61,625. When you look at the problem at the bottom, it says that the finished goods inventory includes this 5,000 of depreciation. That means the depreciation of 5,000, which should have been included in 61,625, lands up in the finished goods, that is the inventory account. So that has to be adjusted. So let us take this adjustment here and we actually add back that depreciation here. 61,000 and 625, add to it 5,000 of depreciation, which was actually not included in the depreciation account but was included in the stock. So you remove it from the stock and add it here. So it becomes 66,625, which is the depreciation for the current year. As I already told you, for the provision for depreciation account, it's liability. Whenever you have to open a liability account, it opens on the credit side and the closing balance will always be on the debit side. While you need to create a liability, take it on the credit side. And because I wanted to create this depreciation of the current year, I have taken it on the credit side. Now I total it, 10,625 plus 66,625 gives me a balance of 77,250. Now the balance of closing is here, the opening is here, I get depreciation, then here comes in the balancing number. The balancing number is 21,250. What does this balancing number reveal? Now this balancing number is the depreciation that has been written off, or rather that has been removed. Why do you write off or remove this depreciation? That is for the reason that whenever an asset is sold away, you remove the amount of accumulated depreciation from the depreciation account. So that is what happens here. So 21,250 is the amount of accumulated depreciation which relates to an asset which is being sold away. Now let us look at the machinery account now. When we are talking about the accumulated depreciation, where is that we need to transfer it? We need to transfer it to the machinery account for a very simple reason, that we see that this amount of depreciation that appears in the debit side is an amount that has to be written off or has to be removed. So how do we remove it? We remove it by transferring it to the machinery account, and that's what we do here. 21,250. Now let us talk about the machinery account. Machinery account is an asset, and the assets always have a debit balance, and the closing balance will always be on the credit side. It opens on the debit side, it always has a debit balance. That means it opens on the debit side and the closing balance will always be on the credit side. Let's open the machinery account. What does the machinery account say here? Let us look at the balance sheet. here and see what does the machinery say. Now what's the amount of the machinery? 2,12,500. Now I said that earlier this amount of depreciation has to be transferred here because this has been sold away. Now what next do they say? They say that when you look into your P&L account, they also said that there was a gain on the sale of machinery. Now what does that mean? Now here when you look into your P&L account, you find that there has been a gain on the sale of equipment. Now see here, the gain on the sale of equipment is 25,250 rupees. So where do I take it? Whenever there's a gain in the sale of the asset, you need to take it on the debit side and transfer it to the P&L account. Take it onto the debit side of the asset account and then transfer it to the P&L account. I'll talk about the second part when we do the P&L account. While here the gains always will have to become has to be taken on the debit side, while the losses of the sale of the machine has to be taken on the credit side. Now it's been, where did I get this point from? I have got this point from the P&L account, which says that there was a gain on the sale of the machine. So let me plug it into the machinery account in the debit side. Now it says in the fourth point, if at all you look into the fourth point, it says that out of this 8,50,000, 2,50,000 pertains to the land. So you have got a plant of 6 lakhs. Of the 6 lakhs, 3 lakhs is paid in cash and rest of it is paid in equal installments going forward. Let us see how do I do this. So here from 8,50,000, I remove this 2,50,000 which is the land. So I am left off with 6 lakhs, and this 6 lakhs of this, half of it is paid in the form of cash. See here, this one, 3 lakhs. This 3 lakhs is paid in the form of cash, and rest of the half is paid in equal installment, which I converted into notes payable. This is what it is. So I break down the 6 lakhs into two parts, 3 lakhs in the form of cash and 3 lakhs in the form of net payable. Now that is notes payable, sorry. Now I have all the numbers plugged in, 1, 2, 3. Now where did I get this number? Cash from. I have sold away the cash, plant and machinery, which is given in point number 6. Refer to point number 6 in your case. It says that the asset is sold away for 2,15,500, and that is what it is. Whenever you sell away asset, you have to take it on the credit side. Sale of asset. When you buy the asset, take it on the debit side. When you sell the asset, take it on the credit side. So I have got the number 2,15,500 from the tax, provision from the provision account, closing balance given, opening balance given, the notes payable, I have got it from 6 lakhs, half of that, and then the gain is given in the P&L account, and this 3 lakhs is half of 6 lakhs, which we have discussed right now. Now when I have got all these numbers, the balancing number, when I balance this number of 13,56,750, then I end up with this cash balance. This is 8,20,000. What does that mean? This means that I have purchased an asset, or the company has purchased this asset for 8,20,000. I will get back to you in the second video.